Welcome to the session on tax transparency at today's conference. My name is Abigail McGregor. I am. Thank you for the comment saying you can see and hear now. I am the head of the tax and private client group at LexisNexis PSL product, and I'm also a fee-paid judge in the first year tax tribunal. And I am moderating today's session on tax transparency. With no further ado, I will hand over to Philippe, who is going to start talking to us about the in-house financial services perspective on tax transparency.
Good morning, everyone. My name is Philippe Sebagh, and I've been working for Société Générale for a few decades now. And for the last 5 years, I've been working as a global tax expert for FATCA and QI. And so we are starting this session that is about tax transparency, and we are going to speak about US FATCA and US qualified intermediary. When we speak about tax transparency, there is the need to mention that the first tax transparency rule that was applied at a worldwide level is the US qualified intermediary that started nearly 20 years ago. The US qualified intermediary, the US QI, is the mother of global tax transparency rules. Given QI led to FATCA, and after that, FATCA led to the OECD CRS rules in the context of the automatic exchange of information that is applied so far in 115 jurisdictions around the world. And apart that, QI also led to the OECD trace model in 2013. That will be a reality with the Finnish trace from 2021. And also with the European Union, which has just started to think about a European trace-like model for 2022. Katja Pussila from the Finnish tax administration will perform a global trace presentation just after this one. So we are going to focus on QI and FATCA. And we just need first to refresh our minds about a few things to make sure you will clearly understand the rest of the presentation. What is a QI? An entity can choose to be a QI and first to sign a QI agreement with the IRS if it holds US securities on behalf of its clients. No, it's not with just please, thank you very much. I will let you know when I need to change the slides. So we are just being introduction, and we are just trying to provide some reminders to make sure you will understand the concepts and all the words that will be used in this presentation. So that's done for a QI. Now we're speaking about FATCA. What is a financial institution in the FATCA context? A financial institution in the FATCA context is a financial institution which has financial accounts. What is an IGA? An IGA is an intergovernmental agreement. A Model 1 of such an IGA was signed for FATCA between the USA and so far 101 jurisdictions around the world, according to which FATCA reporting is made to the IRS through the intermediation of the local tax administration. And an IGA Model 2 was initiated by Switzerland in order to take into account its banking secrecy particularities. There are 12 jurisdictions around the world which chose this model so far. For the last reminder, that is the scope of QI and FATCA, please go to the Annex 1 now. Thank you. As you can see on this annex, QI applies on US source income that are paid to US persons, and also to US source income that are paid to non-US persons. FATCA applies to US source income paid to US persons, and FATCA applies to non-US source income paid to US persons. So after the reminders, let's start. Now you have everything you need to know to make sure you will follow the rest of the presentation. So it will be the second QI and FATCA triennial certifications to the IRS next July. The first ones were made in 2018. And since then, the IRS decided, for obvious reasons, to check the QI certifications first. The fact is that they know QI much better than they do for FATCA. And normally at this stage, all QI compliance certifications were checked by the IRS. So everything is okay. For FATCA, it's a totally different story. Nothing was heard from the IRS about the first FATCA triennial compliance certifications since they were made in 2018. Of course, the pandemic has something to do with that, but it's a bit weird to say that we will have to certify FATCA again in half a year without knowing if the previous FATCA certifications were validated or not by the IRS. And so it raises questions. Now, a few points of attention about the interactions between QI and FATCA, and more precisely, the certifications by the QI responsible officer in IGA Model 1 jurisdictions. Please go to the Annex 2. As you can see on this slide, with all the jurisdictions, and more precisely, what are called non-IGA jurisdictions, jurisdictions without an IGA with the IRS, IGA Model 1 jurisdictions, and IGA Model 2 jurisdictions. In countries without an IGA with the IRS, the FATCA responsible officer certifies the FATCA compliance to the IRS. And it's the same for IGA Model 2 jurisdictions. In IGA Model 1 jurisdictions, there is no FATCA compliance certifications. But in the case the financial institution is also a QI, then the QI responsible officer has to certify the FATCA compliance in addition to the QI compliance certification. So this first case of interaction between QI and FATCA was just a preamble to introduce the important thing you need to know about the interactions between QI and FATCA. That is the case of non-QIs that are members of FATCA expanded affiliated group. Be careful about the non-QIs that are in your group, and especially of the non-QIs that are member of what is called the FATCA expanded affiliated group. Please go to Annex 3. As mentioned in this slide, with the whole group and the specificities of an EAG, a FATCA EAG, expanded affiliated group, is the subgroup of entities that are held directly or indirectly at more than 50% in capital and voting power by any entities of the group. The responsibility in the EAG is something very important. If at least one entity of the EAG is not compliant with FATCA, and whatever if this entity that is not compliant is located in an IGA Model 1 country or an IGA Model 2 country or in a country without an IGA, then this non-compliant entity would contaminate the FATCA EAG. The issue is that a lot of people think that not being a QI, meaning not having signed a QI agreement with the IRS, means that they have nothing to do with the QI rules. it's not right. The QI rules are about receiving US source income, whatever a QI agreement was signed or not. The fact is that if a non-QI, that is a member of an EAG, does not accept to disclose its client with a QI or with a US withholding agent, then the non-QI will be considered by the QI or the US withholding agent as a non-participating FFI for FATCA and will be declared as such to the IRS. The non-QI being a non-participating FFI in this case, it would then contaminate the FATCA EAG. And more precisely, it would contaminate not all the entities, but only the entities that are not covered by an IGA. These entities that will be contaminated will then be considered also as non-participating FFIs by the IRS. And they will suffer a 30% withholding tax on US source income, whatever they are received on behalf of the entity or on behalf of their clients. So you can easily imagine the end of the story for such members of an EAG, and also for the whole group that is concerned. So one of the problems is that following the first QI certifications, some QI responsible officers, given their lack of understanding of the rules, could have found that the questions that were raised by the IRS in the QI certification process was a bit harsh. And so, given the small amount of US source income received, or the small volume of clients investing in US securities, some QI responsible officers could think that being a non-QI could be an option. Actually, it's not. Given a non-QI has more QI obligations than a QI and is far more dangerous for a financial group, especially if it's a member of its EAG. So consider that a non-QI that would be a member of your FATCA EAG has to be overseen not only in the same way as the QIs are, but also in a more specific way than the QIs, given they have more obligations and are far more dangerous. So you need particularly to check that each non-QI that is a member of your EAG accepts to disclose its client with its custodian, that is a QI or a US withholding agent, in order to avoid the non-QI being declared by them as a non-participating FFI and to contaminate your EAG. That is something very important that you need to know, especially before the next QI and FATCA certification. That's the end of this specific information. And now we are going to another subject that is a question that is often raised when I have to speak about FATCA. It's the question of what is the foreign pass-through payment. And more precisely, what is the concept of a foreign pass-through payment? What does it mean in practice to apply the foreign pass-through payment? And what are the risks that it could apply in the future? Because at this stage, in the final FATCA regulations, the foreign pass-through payments rules are reserved. And we're going to explain why. So, first, for the foreign pass-through payment concept, please go to the Annex 4. Thank you. So we are going to follow this very simple example that will permit you to understand the concept of foreign pass-through payment and also the one that is very important of blocker entity that is used in the concept of pass-through payment. So let's follow the flow chart. Just imagine a US corporation paying a US dividend through the US Central Depository and through a US custodian. The US dividend is paid to the custodian of an investment fund. In this slide, the flag that is used is a French flag, but it could be any country around the world apart the USA. When the US dividend is paid to the custodian of the investment fund, it's still a US dividend. And when the investment fund paid the US dividend to the investment fund, it is still a US dividend. But when the investment fund will have to pay a dividend, it will be, in this case, a French investment fund dividend, because from a pure legal and tax point of view, the dividend is paid by the investment fund that is located in France. And so there is a transformation of the source of the income into a French source income. After that, the investment fund so paid to the custodian of the investor, and the custodian of the investor paid to the investor. In this case, in my example, the investor is a non-participating FFI. And so, in this example, as you can see, it seems to be very easy to circumvent FATCA in this kind of concept. Because, as you can see, even if the investment fund, for example, holds 100% of US assets, meaning it receives only US dividends as this one. When the investment fund pays a dividend, it's not a US source dividend. And so, even if it is paid to a non-participating FFI, there is no withholding tax and no reporting. So that means that at the end of the day, if a US investor is hidden behind a non-participating FFI, it would permit the US investor to receive what is called by the IRS a US source income without having to suffer a withholding tax, nor to be reported. So that is the concept of the foreign pass-through payment. And in this example, the investment fund is called the blocker entity. This term is very important in this concept because it is clearly the possibility to identify or to add a name, a dedicated name, to the entity that blocks the US source dividend and transforms the US source dividend in a dividend that is sourced in another country. And so, in this context, as you can see there, it's something very easy to do, especially for an investment fund. That's why I took an example with an investment fund, but it could be the same with any kind of entity around the world. So, following the publication of the notice 2015-60, so it was 5 years ago by the IRS, the foreign pass-through payment was postponed. And to avoid the use of this kind of scheme, it was necessary to report each payment made to NPFFIs and recalcitrants, just to permit the IRS to have the ability to assess the risks from a pure statistical point of view of circumvention of FATCA. It was 5 years ago, and nothing was heard from the IRS since then. And I do remember 3 years ago, I performed a dedicated presentation of the pass-through payment. It was in London. It was for the OSNI Media Conference. So I made a presentation that lasted nearly 1 hour, especially in this concept. It's just a summary of a presentation. And so just after my presentation, we had a video call with the IRS. Because at that time, as you can imagine, we were preparing the first QI and FATCA certifications, and we had to deal with the IRS with a lot of things. And of course, as you can imagine, the question was raised about the statistics of the payments that were made to non-participating FFI. How many payments? How many NPFFIs? What was the global amount paid to NPFFI? And the IRS did not accept to answer these questions at this stage. They said that they needed to identify more precisely the statistics that they received. But so far, we haven't heard about anything. So that's why we're still speaking about this subject, because it's still a threat above our heads. So the second question I raised in the context of the foreign pass-through payment is what it means in practice. So in practice, applying the foreign pass-through payment rule consists in computing and publishing the percentage of US assets held by any entity paying a dividend. It's called the PPP, the pass-through payment percentage. And it will permit to have a knowledge of a percentage of a dividend that is sourced in the US. In my example, I told you that you could imagine that the investment fund could hold 100% of US assets, and so that the dividend that is paid by the investment fund would not be taxed. So you could imagine that in this context, the pass-through payment percentage of the dividend that is paid by this investment fund would be 100%, meaning that 100% of this non-US source dividend from a pure legal and tax point of view would have to be considered as a US sourced income in the context of FATCA in order to permit the taxation and the reporting of such a payment of dividend. So as you can imagine, if we would have to apply that, it would be something complex, costly, and risky. And that's why at this stage, it is something that is just reserved. And nobody knows if it could apply, and especially when it could apply. But what we know is that it's something very easy to make the foreign pass-through payment apply, because at this stage, it could be applied just by defining what is a foreign pass-through payment in the US Federal Register. That was the last thing that was mentioned in the documents provided 5 years ago. It's by when a foreign pass-through payment will be defined in the US Federal Register, that means that the foreign pass-through payment could be applied. So be careful, especially if you're an investment fund holding US assets, not to be in a bad position in the case there would be a non-participating FFI holding your investment fund, even partly, just because there could be US investors hidden behind this non-participating FFI. That's all I wanted to say in the context of the foreign pass-through payment. And now, if we have the time, I just would like to finish my presentation with a dedicated part that is the extension of the discussion to over extraterritorial rules. By extension, think about over extraterritorial rules, because I'm sure you have already heard about the US Securities Act, the US Investment Advisor Act, the US Dodd-Frank Act, the US estate tax. But do you know that when you sign an agreement with the IRS, such as for QI and FATCA, you commit to be compliant with US rules in general, meaning that even extraterritorial US rules over than QI and FATCA. So just above the last one of the list I have just mentioned, meaning the US estate tax, do you know that for an entity that holds US securities on behalf of its clients, for a client that is neither a US citizen nor a US taxpayer, meaning an individual client that is not a US person. If this client dies, and if at the time of their death, the non-US person held more than $60,000 of US securities, then there is the obligations first to report the non-US person to the IRS, and there is a dedicated form for that, that is form 706-NA. Second, there is the obligation to block the money from any transfer to the heirs of the dead client until it is allowed by the IRS, meaning until the US estate tax will have been paid. There is an exception to this rule. If there is a double tax treaty between the USA and the country of residence of the dead client, and if this double tax treaty is about estate, then there is no need to apply this rule. But the fact is that there are only 16 of such double tax treaties around the world. So to summarize, US securities that are held in a custodial account by a non-US person outside the USA are called US CITUS assets, meaning that such US securities are considered as assets that are physically located in the USA, and for which the US estate tax has to be paid if more than $60,000 are held at the time of the death. So think about that and think that you have to abide by US rules in general, in the case you have signed an FFI agreement or a QI agreement. Thank you for your attention. We will keep on discussing about QI, FATCA, and other US extraterritorial years during the session of questions at the end of all presentations. And now, Katja, the floor is yours for the global trace presentation.
Katja, I think you might be muted.
Oh, thank you. Apologies. Okay. Let's see. Just a minute. Apologies for the hassle. I guess you can now hear and see me. So thank you, Philippe, for the presentation, and hello, everybody. My name is Katja Pussila, and I work as a senior advisor at the Finnish administration. My main focus area is the issues related to the financial industry, and for the past couple of years, I've been very much involved with the Finland's trace implementation. As Philippe already mentioned, I'm going to give you a short presentation and introduction into the OECD's trace model and how it's related to the concept of tax transparency. I'm going to address the issue not only from the Finnish perspective, but also from the OECD and the EU perspective. Then we can go to the next slide, please. Thanks, Frade. So what is TRACE? TRACE stands for Treaty Relief and Compliance Enhancement. As stated in the name, it's a standardized system for treaty relief, meaning it's a model for granting treaty benefits already at source at the time of the payment. In that way, the investor doesn't need to go through an often quite burdensome and costly refund procedure, but can get the correct tax already at the time of the payment. It's very important to understand that the TRACE is first and foremost a set of procedural rules, and it doesn't take a stand on the substantial matters like on what rate a country should tax the income. It simply harmonizes what information the intermediary should collect from the investor, how the information should be validated, and how the information should be reported to the tax administration. The trace consists of few key elements. One of the key elements is the role of an authorized intermediary, which is in many sense very similar than the role of the qualified intermediary Philippe was telling us about. Authorized intermediaries can claim exemptions and reduced rates of withholding tax pursuant to the tax treaties or even domestic law on pooled basis on behalf of their customers that are portfolio investors. One of the major benefits to intermediaries of such system is that the information regarding the beneficial owner of the income may be maintained by the intermediary with the direct account relationship with the investor. So there's no need to pass on the privileged customer data up on the chain to other intermediaries. It is also required that the investor information is then reported to the source country's tax administration on beneficial owner level. So the AI can claim the benefits at the time of the payment on pooled basis, but then usually on annual basis, they need to report the actual beneficial owner data directly to the tax administration. Another key element of TRACE is the investor self-declaration procedure. Under TRACE, investors are able to indicate their entitlement to reduced rates by providing a standardized investor self-declaration to the intermediary with respect to which they have the customer relationship. So to make it more easier, so it's basically you offer the investor self-declaration to your own bank where you have the account, where you have the safekeeping account, where you hold your securities. Obtaining a certificate of residence can be very costly for investors. And due to the fact that certificates of residency are usually available in paper format only, and often tax administrations accept only originals, it means that in the current system where the certificates of tax residencies are required, it means that a lot of physical paper are transmitted. First it as a tax official of the residency country that issues the certificate of residence. Then they give it to the investor, who then give it to the intermediary, and then the intermediary processes it. And then usually even the source country handles the certificate of residence. And that is very time consuming and costly for all parties, not just for the investor and the intermediary, but also for the officials of the residency country and the source country. That is one of the reasons why I'm a huge fan of the ISD procedure myself. I often hear from my fellow colleagues in other countries that they are very skeptical on the ISD procedure and its reliability, and are very hesitant to give up certificates of tax residency. But personally, I really want to emphasize that the ISD isn't just a piece of paper signed by somebody. It's a piece of paper where the investor tells about his or her tax status, and they need to undersign it, and they need to say that they are beneficial owners of the income. And it's even more than that. When they provide it to the intermediary, that is an authorized intermediary, the AI must validate the information. If you think about certificates of tax residency, it only states that somebody is resident in some country. It doesn't take any stand on the other criteria whether the tax treaty is applicable to that situation. For example, I'm definitely resident in Finland, but that fact alone doesn't mean that I'm the beneficial owner of certain income that I might receive from abroad. That's why I think ISD procedure actually takes one step ahead to the current process that is very much relying on the certificate of tax residency. Then one aspect with the ISD procedure is also, like I said, it needs to be validated by the AI. And validating the ISD means that, if I just simplify it, it's not quite that simple in practice, but it basically means that the AI must compare the information on the ISD to the other information they have on that specific investor. Meaning that if I would go to my bank and I would give them ISD stating that I'm a Swedish resident, and they can see in their system that actually this woman lives in Finland and she doesn't seem to have anything to do with Sweden, the intermediary should question the validity of the ISD that I just provided. So if you combine these together, I think we have a much better system with respect to tax transparency, but also with respect to avoiding fraud in general than the current process that is basically very much relying on certificates of tax residency. And that's the case regardless whether we are speaking about the refund procedure or relief at source. Then another key element of TRACE is the TRACE XML schema. We should never underestimate the importance of standardizing the technical reporting, because it shouldn't be enough, it isn't enough, and we never should consider it to be enough that we standardize the model itself, because we need to make sure that once the tax administration receives the information is in a format that the tax administration actually can use and utilize for taxation purposes. And it's also a very important aspect for the intermediary. If you think about an AI who has clients all over the world, and if we could imagine this ideal world where every country would adopt TRACE, it's a much more cost-effective for the intermediary to report the data with the same technical schema. So that's why I think the schema plays at least as big of a role as the other aspects of TRACE. In addition to the AI procedure, ISD procedure, and the schema, TRACE also contains the concept of independent review, which means that the AI can request the independent reviewer to review their processes from the compliance perspective. That's something I won't go into in further detail. It's very well explained in the OECD TRACE implementation package. Naturally, also, the automatic exchange of information is a very crucial part of the TRACE model. In practice, that would require more countries to adopt the system to be effective. So, but in principle, the idea of TRACE is based on the idea that the information is also exchanged between the countries involved. That's all about the key elements. I know it's a very short introduction, but I really want to address the tax transparency side of it. Please go to the next slide. Like I promised, I said that I would go through the issue from the OECD, the Finnish, and the EU perspective. Like said many times before, the TRACE was drafted and by the OECD, but not by the OECD alone. It was actually a joint operation with the Business and Industry Advisory Committee. So it has actually been developed by the OECD and the industry together to make sure that it would benefit all the parties and take away inefficiencies within the current systems. It was published in 2013, but naturally it didn't come out of thin air. The work had begun already in 2006. But as probably you guys know, there hasn't been any countries implementing TRACE. But I think personally, I believe that it has nothing to do with the TRACE itself. It's more related to the fact that then we had FATCA and CRS and all that automatic exchange of information aspect kind of took the momentum away from TRACE then. But now I think the momentum is back, and I'm going to tell you later on why. OECD also published a schema, so the technical reporting schema and the user guide in 2020 after Finland had announced that Finland will be implementing TRACE as the first country in the world. So the Finnish perspective, like already mentioned, Finland will be the first country in the world to adopt trace as it is, and I'm very much proud of it to tell you that. It will be applied to dividend paid to nominee registered shares starting from 2021, so next year. So we are very close to the date when we are start applying the system. We will be having the AI procedure, the ISD procedure, and the reporting is done with the trace XML schema. I'm not going to go into more detail on the Finnish system so that we have time to address other issues. But if you are interested, please visit our webpage. We have held several webinars that you can find the recordings from our webpage, and we have a dedicated site for the legislative change. Then the EU perspective. I think some of you that haven't heard about the Commission's plans might be wondering why we have an EU flag in an OECD-related system. And the reason is that EU Commission released their Capital Markets Union Action Plan in 2020, not so long ago. And the action then actually contained an action where the goal is to have some kind of legislative initiative by 2022, which basically means trace or trace-like system. This is naturally very interesting for us because it is definitely a game changer if we can get EU involved with the trace. I guess no one knows the exact plans behind the idea, but the strong initiative and the strong comments that both the industry and us have addressed to the Commission is that we would really like the EU system to follow trace as closely as possible. Why invent something new if there already is a very much working system that has been already created? But we will keep close eye on those plans. I think that's all for that part, and then I would like to go to the next slide and talk a little bit about the tax transparency aspect. When we talk about trace, we often talk about removing barriers for cross-border investing, but the trace plays a key role from the tax transparency perspective too. People have asked me why we even need more tax transparency initiatives. Isn't CRS enough? I would say that the CumEx phenomena should have proved to even the most skeptical ones that the need for tax transparency towards the source country is very much needed as well. Trace also doesn't benefit the source country alone, it benefits the residency country as well. I can give you an example. Let's imagine that we have an investor that claims that they have received enormous amount of dividends from Finland. But then they haven't declared that income in the residency country. Naturally, there can be legitimate reasons for that, but it can also be a sign that the investor has either tried to avoid the Finnish withholding tax on behalf of somebody else, because that investor would have better
Katja, do we still have you?
Yeah, it's just downloading. Just a minute. I don't know if you can hear me.
We can.
I'm back. Yes, I'm back. Apologies again for some technical hiccups. Yeah, it's working again. Apologies again. So I was saying about the example on the investor who is claiming that they have received an enormous amount of dividends from Finland, but they haven't declared it in the residency country. And I said that there can be legitimate reasons for that, but it can also be the sign that the investor was either trying to avoid the Finnish withholding tax on behalf of somebody else, or they are trying to avoid the residency country tax on the dividend that they actually did receive from Finland. Either way, without initiatives like TRACE combined with CRS and automatic exchange of information, these kind of arrangements could fall under the radar. If we wish to pursue true tax transparency, the CRS must be accompanied with TRACE in order to be sufficient. Then I want to just quickly address the cost issue. We as the tax administration very well understand that enhancing tax transparency requires balancing with increasing compliance costs. There can be a truly transparent system in theory that is so expensive that no one will apply it in practice. When Finland announced that we will be implement TRACE, the biggest question or concern was the compliance costs. There's always going to be some costs involved when you are adopting a new system. The reason why I'm personally so excited about TRACE is that it significantly improves tax transparency, not only for the source country, but for also to the residency country when proper automatic exchange of information is in place, but with reasonable costs. The reason why the costs are reasonable is that TRACE model utilizes already existing information to very large scale. TRACE has a lot of similarities with CRS and DAC2, and even with FATCA. TRACE also uses the anti-money laundering and know your customer rules information that the AEoI already collected based on another legislation. Even the technical reporting is done with the XML format that is very much similar to the one that we use for CRS purposes. Naturally, the costs vary from tax administration to tax administration and the intermediary to intermediary, depending how advanced the technical software solutions already are being used. It's also important not to look only to the cost by the implementation, but also take into consideration the money saved through effective procedure with less manual work. And that is the case for tax administrations as well as for the intermediaries. And all in all, personally, I would say that TRACE has a good balance between the need to enhance tax transparency, but with reasonable costs. Thank you for listening, and I will hand the floor to Alex Cobham, who will be telling us from the tax transparency from the activist or campaigner's perspective. Thank you very much.
Thank you, Katja. Let me share a file with slides and then begin. So this will be slightly different. I want to take a bit of a step back and kind of think about the broader picture of tax transparency, how things have moved over the last 20 years or so, how we got here, and then where we might go next. Thinking more, I guess, from the public point of view rather than that of financial institutions, thinking about where the demand for this transparency comes from, what it can deliver, the role of investors who are also very active in demanding elements of this, and what that means in terms of the broader public attitudes and where policymakers might go. The Tax Justice Network, I am contractually obliged to tell you, is an independent international network of experts, economists, accountants, lawyers, other tax professionals, political scientists, academics, and so on. Formally established in 2003 although informally in the couple of years before that. So we're getting towards 2 decades of life, and there's a broad global movement now around tax justice, pushing for effectively tax policy decisions, including those around financial transparency and regulation, to be taken in a context where social justice concerns are part of the decision, rather than, as was often the case, narrow technical decisions being taken as if they didn't have broader social and political implications. What I'll talk about is, as I say, how we got here really, and how this agenda moves from absolutely in the margins to being the core of a global policy agenda, and then thinking where we might go next from here. So the starting point from a tax justice perspective is what we call the 4 R's of tax. These are reasons really why an effective tax system is important for all of us. Most obviously, revenue. And in these days, it's hard to think about tax without thinking about the importance of funding public health systems during the pandemic. But revenue is really only one piece of what tax gives us. Effective tax systems deliver effective redistribution, and if we are serious about challenging inequalities, and again the pandemic has laid bare just how deep those inequalities are in our societies, then we need effective redistribution. Repricing relates to this question of being able to change the relative private costs of public goods and public bads. In particular, we might think about that without an effective tax system, we are unlikely to be able to reprice carbon emissions and other climate damage in such a way that we can ultimately protect the planet for future generations and indeed the current generation. But perhaps the most important of the 4 R's, and also often the most overlooked, is representation. The old US rallying cry for independence from the British Empire was no taxation without representation, but actually the evidence suggests it's largely the other way around. There is no representation without taxation. It is when people pay taxes, and especially direct taxes, on their incomes and their profits, the taxes that are most visible to people and most annoying in some ways to pay, that governments become more accountable and actually more representative politically. There are very few things over time which are associated with improvements in governance, reductions in corruption. A critical one is the share of government spending that comes from taxing its own citizens, and that is the key driver of effective political representation. So with good tax systems, we don't just have more money for governments, we have more chance that the governments use that in ways that challenge inequalities, that are inclusive politically, and are capable of taking this longer term view from repricing. So this is why we care. But in terms of tax transparency, a question about how we get there. Oh dear, there's a problem in my slide. I will have to talk to this. You'll have to imagine that you can see this. What this slide should be showing you is the ABC of tax transparency. And this is the policy platform that the Tax Justice Network put together in the first few years of our existence, 2003, 4, 5. Now, the A is what we've heard a lot about today, the automatic exchange of financial information. Remember that in the early 2000s, the international standard was for information exchange upon request, which in practice meant that financial secrecy jurisdictions would receive a request. For example, Jersey would receive a request from the United States, sit on it for quite a long time, and then decide that there was some technical reason why the request wasn't valid, or that it was a fishing expedition, and provide no information in return. Having automatic information provided from between financial institutions and tax authorities gives us a completely different impact. Using data from the US Internal Revenue Service, for example, they find that tax compliance is as much as 7 times greater when there is an automatic third-party provision of information, when taxpayers know that the IRS, the most powerful tax authority in the world, isn't directly receiving that information from anywhere else, tax compliance is much, much lower. So automatic information exchange is crucial, really, to having people declare their offshore accounts and income streams. B is for beneficial ownership transparency, touched on here, and obviously FATCA and the OECD Common Reporting Standard have been very important in cutting through some of the old objections. The claim that you couldn't identify a beneficial owner for a trust, for example, has had to be parked, really, because of the demands of FATCA. All of the remain challenging technical questions there. What we've called for there is effectively that beneficial ownership information about the ultimate warm-blooded human being for companies, but also other legal entities, trusts and foundations, should be in the public domain. Not held in private registers and not ignored, but in public registers with open access to all. The reason for that is effectively a trade-off. When you create a legal entity in order to own things, it creates a whole set of risks for the people you do business with, for government revenues, for your suppliers, for your rivals, if you are able to hide who you are. And that's why the very long-standing quid pro quo is that, for example, when you create a company with limited liability for directors, you are expected to provide more transparency, for example, to publish the accounts of your company. And that's well established over centuries. Beneficial ownership registration is an element of that, part of the quid pro quo of the benefits of establishing legal entities, that the warm-blooded human being behind it should be visible. And finally, the C of the ABC is country-by-country reporting. Now, this is a measure for multinational companies, effectively to put them on something of a level playing field with domestic businesses that publish annual accounts. Because multinationals over several decades have managed to weaken the international accounting standards that apply to them, taking out things like segment reporting, including geographic segments, we simply don't have the country level transparency that we get from a domestic business. And so the biggest economic actors in this globalized world are also, by and large, the least transparent at the national level. So country-by-country reporting, for which we published a draft accounting standard in 2003, is a measure simply to require multinationals to report on a country-by-country basis where their economic activity is. That's their employment and their ultimate third-party sales, and where they declare their profits and how much tax they pay. Simply, as I say, to put them on a level playing field with others. Now, look, all of these three measures, the ABC, when we put them forward, were written off as utopian and completely unrealistic. Tax authorities, policymakers, the OECD simply said, perhaps at a technical level we can see the value of these, but these are, wildly unrealistic. They won't ever happen. But things change. And as the movement built, and I think the impact of the financial crisis, in particular, in causing much greater public engagement on this, we had a significant shift. So 10 years later, the G20 group of countries in 2013 effectively adopted the key elements of the ABC. Following FATCA, they introduced the OECD Common Reporting Standard, a more or less genuinely multilateral standard for automatic exchange of information. The UK and others, and then the EU, and then the UK's dependent territories have set off on the road to public registers of beneficial ownership, in the EU case at least, for trusts and foundations as well as companies. And the OECD has adopted a standard for country-by-country reporting with some technical weaknesses, but significantly based on the original Tax Justice Network proposal. So progress, and yet many obstacles remaining. I won't talk much more about automatic exchange, except to say a key element of this we're starting to see in a number of countries is aggregate data being published. While the account data clearly is private information, and for financial institutions, individuals and tax authorities to hold privately, the aggregate data should be in the public domain so that it is clear which jurisdictions are the source of offshore accounts. If, for example, we now have from Australia, say, by a legal amendment, we know the difference between the volume of accounts that are declared to the Australian tax authority from each other country versus the volume of accounts being upon which information is being exchanged. So it's clear where the tax authority needs to go to fill in any gaps. It's also clear which jurisdictions are potentially the most problematic. And that gives accountability both for the tax authority and for jurisdictions one to another, and ultimately to the public about the potential provision of damaging financial secrecy. In terms of beneficial ownership, again, I think we've touched on a lot of this. There are currently more gaps than there are effective registers, but we are moving, it feels, towards effective international standards, starting with company registers for public information. Our financial secrecy index, published every 2 years, provides an analysis of a whole set of indicators that underpin whether beneficial ownership structures are effective or not. And we see progress, gradual but consistent, in each subsequent edition of the index. Lastly, in terms of country-by-country reporting, the issue we have is that the OECD standard does not require the data to be made public. Now, that means that multinationals provide some transparency and accountability to tax authorities, but no accountability to the public, and there is no accountability, importantly, of jurisdictions to the public. We need this data in the public domain to understand the patterns of profit shifting, and the OECD has finally this year published some aggregate data allowing us to see, for example, that more than $100 billion a year are shifted into the Netherlands, despite the absence of related economic activity there. That type of information is driving accountability relations within the Netherlands, within Dutch politics, but also within the EU and internationally. And it's that transparency that ultimately is going to give us the political progress that's needed. Lastly, where are we going next on all of this? Briefly, country coverage is a key problem. So many countries, particularly lower income countries outside the OECD, are excluded both from the Common Reporting Standard for automatic exchange of information and from the arrangements for the exchange of privately held country-by-country reporting information. That means these transparency measures are actively exacerbating the global inequalities in taxing rights that lower income countries find. And the lack of consistent transparency to the public means that we don't have those accountability relationships fully in place. Aggregate statistics are a key part of that. And in the OECD country-by-country reporting case, it is critical, as investors with trillions of dollars of assets under management said earlier this year in the OECD's review of that standard, that the standard converged to the much more robust standard produced by the Global Reporting Initiative, which is now being used by some multinationals like Vodafone for voluntary public reporting. We need that to be mandatory across the board. On beneficial ownership, we need an international standard established so that this is not only a coalition of the willing, but consistently observed around the world. And what's increasingly being discussed now at the United Nations is the possibility of a convention on tax or tax transparency, which would establish multilaterally and in a globally inclusive way the ABC of tax transparency as comprehensive standards. I think if the OECD and related organizations like FATCA do not do this, that pressure will become inexorable. And so there's a question there for financial institutions and investors and others, whether they want to engage now to push the OECD to deal with the manifold weaknesses in their approach, or to see this move to the United Nations. The last thing I will say, we now have, between the aggregate country-by-country reporting data and the Bank for International Settlements publishing locational banking statistics, not the detail of what's in the Common Reporting Standard, but a step forward nonetheless. We have sufficient information to construct country-level estimates of the revenue losses to both profit shifting and the offshore holding of undeclared financial assets, with more or less global coverage. So as of this Friday, we will begin a new annual publication called The State of Tax Justice, publishing those revenue estimates plus assessments of the damage that different jurisdictions do by providing financial secrecy and profit shifting facilities, in the hope that this will eventually push international organizations, the OECD and UN bodies, to take on this role in a more official capacity. But until then, to make sure this information is coming into the public domain and driving these types of accountability and the process of greater progress on this broader tax transparency agenda. So with that, I'd be very interested to hear discussion and questions on this, but let me finish there and say thank you and hand over to António. Thank you.
Thank you, Alex. Good morning, everyone. Let me just find the slide deck I need to share. Okay. My name is António Correia. I'm a senior tax advisor at EFAMA, which is the European Fund and Asset Management Association, representing 60 corporate members, 28 national associations, and 27 or well, more than 20 associate members, including law firms, consultancy firms, and other type of associates that help us enriching our position. So I'm going to speak a bit about some points that were already touched by Philippe, Katja, and Alex, but I'm going to address first the tax transparency effects on our industry. And to start, I will discuss a bit on and deliver some points on how we can balance tax transparency and at the same time protect end investors from higher costs. And we have been monitoring the several activities at the OECD and EU level, and in recent years we saw that member states agreed on a series of instruments in the field of tax transparency that allows tax authorities to cooperate closely and exchanging information between each others. And we have been monitoring the implementation of these instruments, the several DACs and more recently DAC 6. And we see that tax authorities globally are becoming more focused on aggressive tax planning, perhaps agenda. And we see that the increased reputational risk associated with these practices, the industry needs to monitor this and to make sure that best practices are implemented. And we want to be seen as and to do things the right way. And this is a demand not only from tax authorities, but also from investors. So this is a clear message that we want to pass today, and moving forward on something that tax reporting, compliance, governance, these are key areas in ESG environment. Now, this is more and more relevant for the industry, and we want to more and more adhere to these new standards and regulations, and to respect these rules, making sure that the entities in which funds invest also operate under an appropriate tax governance framework. So this is critical for everyone. We have been monitoring this, exchanging views, experiences on the challenges that arise from the implementation of the several measures that are in place. And we help our members to get prepared, to plan, to implement the reporting strategies in order to fulfill the compliance obligations. But what we see more and more is that streamlining of procedures, examples like we have always advocated for trace or for other initiatives like the code of conduct on withholding taxes. This I will address in the next question that I've prepared some bullet points to speak about this. But we see that the industry really understands that the better way to protect end investors is to streamline procedures and reporting requirements and reduce costs. What we see also is that the concerns of the industry are more and more being acknowledged by policymakers, and from our perspective, we are dealing with a highly regulated industry and investment pooling vehicles that have a certain tax treatment also for public policy reasons, valid reasons, and for the social impact the industry has, and the added value that the industry can give in reboosting economies. And what we see is that generally we don't, the vehicles do not pose bad risks and are not supposed to be targeted by these actions. But we support obviously the primary goal of achieving fairer tax systems and to have increased tax transparency. But the design of these rules and the tax transparency rules and these tax transparency systems should not bring additional costs for the industry. So what we need is certainty. From a taxpayer perspective, the reporting should be proportional to what is being designed for, and from the tax administration perspective, we will understand that the information being requested and used is relevant and targeted. So we need to really to focus on the areas of real risk and deploy resources appropriately, both from the investors and from the tax administration side. And I believe Katja already touched on this point before. So it's also important to level playing field and to in terms of timing, scope, perspective, and it's really important to harmonize procedures and rules. And so we have seen this in practice. And another area, for instance, you have already discussed a bit on CRS, but this when we see that it's easier to implement these measures when you have an harmonized approach and common guidance can be used. So this for the first question. On the second question that I've been asked to discuss today is, does tax transparency lead to denial of access to withholding tax relief at source or reclaims? And on this, I can say that obviously, because the tension over tax scandals that you have been mentioning, we know that there's a significant increase in the practical requirements for investment funds to access treaty benefits and relief at source or withholding tax reclaims. In this respect, we are in favor of simplification. We agree with and we help also to design the trace model. But members agreed that probably we can think a bit ahead, and we have agreed on start exploring how technology can help both the industry and tax authorities to address some of the questions and some of the points raised by Philippe, by Katja, and by Alex on how we can get full transparency and at the same time a trusted system. And we are going to explore that. We have designed our proposals, and we are starting to discuss them with the relevant units at the tax suite. And soon, I'm sure we will be discussing with Katja and other tax authorities to engage and to see that if we have a cooperative system where stakeholders and interact and all relevant stakeholders participating in constructing the systems, that is the best way to address the tax transparency. That is the only path to get a full tax transparent system. To start, we will start. If you want to know more about our blockchain for taxes project, happy to engage. Please get in contact. But is to say that we want to enhance the relief at source procedures. They are, I would say, everybody would agree that this is always the best solution. But and we understand that technology can help us to block holdings or transactions where the right entitlement is not validated by all the parties interested. So, and we will explore that and engage with the Commission, as I said. And we want to build entitlement matrix, and that would allow us in the end-to-end automated system to at the end, investors and tax authorities will co-sign smart contracts, and this at the end will help us to recover the loss that is imposed by the existing burdensome of the relief procedures that Katja was mentioning before, and also will help us to protect the industry and then the investors from the risks that arise from tax fraud and from these cases. So happy to address your queries during the next session. I'm handing over to Abigail.
Thank you very much, António, and to everybody else, to Philippe, Katja, and Alex, all of your insightful comments there on varying issues related to tax transparency. We are obviously quite pushed for time now for our Q&A. We've had one question come in during the session. I think it was during Katja's session, and the question is: it may be difficult to define who the beneficial owner of an asset is. At the simplest level, a corporate investment entity may own the asset, but a shareholder in that entity may be a beneficiary. Did you want to expand a little on that question, Katja?
Yeah, sure. The issue of the beneficial ownership is obviously, apologies, very complex. And my example was very much a simplified version of the actual issue. What I was referring to was the beneficial ownership within the meaning of the tax treaties, which is also quite a tricky question. Who should we consider beneficial owner within the meaning of the tax treaties? Because it might not be the same entity as the legal owner of the shares. So, and then we have the other side of the beneficial ownership with respect to who is kind of the party in control of the entity. So the beneficial ownership is a very large and difficult issue that has many aspects on it, and my example was very much a simplified version. And I was referring to the beneficial ownership within the meaning of the tax treaties. I hope that answered the question.
It is an interesting question in the context of the self-reporting, the investor declarations in Trace that you were referring to. I can envisage a situation where a person might struggle to understand whether or not they are correct in making that declaration.
Yeah, definitely.
So I think,
and that is definitely an issue that we have already recognized. And what we've said is that in these cases, they need to contact either their own tax administration at the residency country or us as the tax administration of the source country. And we can then give them a ruling or guidance on whether they should be considered as beneficial owner. And I do understand that this won't work in practice. Everybody cannot request these kinds of guidance every time for regarding each country. So I think the issue is larger than just towards the Finnish tax administration. It's a very large issue at the moment regarding on the market in general, and we cannot resolve it alone. So, but that's the best we can do at the moment, is just to help these people signing these investor self-declarations by saying that they can contact us if it's unclear. But it's also important to keep in mind that the majority of investments, if you think about the amount of investors, are usually, we have lots of investors who have owned the shares forever, and then the beneficial ownership is very much clear. I think the issue arises with all these sorts of arrangements that entities might enter into. And yeah, well, I don't have any solution for it, but that's just, we are very much aware of the issue, and it's a very ongoing discussion that we are also having as a tax administration with fellow tax administrations, but also with the industry.
Okay. And we have a few more minutes for questions, and there are some more general questions that I was going to pose to some members of the panel. What are your views on whether tax transparency improvements are necessarily done supranationally? In the UK, we've had quite a few tax transparency initiatives that are unilateral, like senior accounting regime, tax strategy publication, and there's a current proposal to introduce notification of uncertain tax treatment by large businesses, although that's just been deferred by a year. Do you think that unilateral efforts can make an impact too, or should we be sticking to supranational efforts? I'm going to target that question at Alex first, and then other people might chime in.
Thanks, Abigail. I think, you know, we are broadly in favour of multilateral progress in these areas, but you have to be realistic. We know that you know, there's so much opposition. You know, when we began working on this in the 2000s, you know, you couldn't get a hearing on most of these questions, and the idea that you'd have said we'll go from here to an international standard in one bound, as it were, just wasn't realistic at all. I think there's a couple of things then that you can imagine at the unilateral level being particularly useful. So one is where you have, you know, an individual country with significant power taking steps, and the obvious case there is the US using FATCA to kind of break the back of Swiss banking secrecy in a way that the EU had never managed with the Savings Directive, and suddenly it was open for everyone. The remaining question now is who will put an end to US banking secrecy, and I think only the EU is big enough to do that, and we will see if we get there perhaps under a different administration. But then the other thing is kind of what it opens up if you do it well. And the UK is an interesting case because it's, you know, the UK sits at the centre of this network of secrecy jurisdictions that's the biggest single secrecy actor globally. So when, you know, David Cameron, say, refused to take significant steps across that network, but introduced public registers of beneficial ownership for companies in the UK, it did send a powerful signal. You know, and so I know that was criticised as being sort of ducking the issue of the UK's bigger problem, but took a big step, I think, to allowing others to say, okay, we can do this too, and the door is open. And I think in 5 years, you would think we will have a comprehensive international standard for public registers that David Cameron would be able to take some credit for. So, these measures can work, and particularly I think for lower income countries who often feel they can't move if the OECD doesn't allow them to, for a bigger country to do something can open the door in a way that's useful.
Did anybody else want to add anything to Ali's comments there? Or shall we move on to the next question as we are pressed for time? Okay. Oh, António, did you want to say something?
No, just to say that, well, to have some, it's really critical to have, at least at the EU level, you need consistency and harmonization. You see the example from what is happening with the implementation of DAC 6, and it's critical if everybody works in the same manner with the same guidelines. So the Commission and might have been a bit too overambitious when giving so much power for national and for member states to develop the broad concepts that you have. That at the end, I'm not sure if the implementation will be effective. And this comes with additional costs, because to find out what's happening and to implement a strategy, at least from an industry standpoint, I'm sure that from tax authorities, if they talk to each other, they can learn a lot from and we are trying to do the same from an industry side. So dialogue and cooperation is essential. So you can have both efforts at the national level and multinational level. So.
If I can agree with a particular point there, the EU's introduction of a limited form of country-by-country reporting for banks under the Fourth Capital Requirements Directive has been a disaster. The standard allows countries to interpret it differently, and countries allow financial institutions within their country to interpret it differently. So the compliance costs are more or less what they would have been if you'd had a proper consistent standard introduced, but the benefit of the data is very limited. I mean, actually those banks are, the academic research shows that they're paying about 10% more tax than they were, so that's not to be sneezed at. But in terms of the ability to hold them accountable and to compare the data, it's really, we're hoping now that the EU may require the OECD standard data, which has problems but at least is consistent, to be made public across the board, and that would at least make sure with almost zero compliance costs that you have data that's got some value. So on that we'd certainly agree, the multilateral approach is valuable.
Okay. I mean, this is a point that was raised by a number of you during the course of it, and in fact just by António just there. There is inevitably always a balance to be had between enhancing the information flow to enable transparency and the burden on business to comply, with, of course, the possible consequence of costs being passed down to ultimate consumers. Do you believe the balance is being met now, and do you think that future proposals risk unbalancing it? Philippe, shall we go to you first for this one?
I guess it's something difficult to have a right balance in this context. And so that's why I just think that there is the need to have a global view to make sure that it's not only one country that could, such as the USA, put the pressure around the world without having the possibility to have a reciprocity, as it's the case so far for FATCA, for example. There is not a real reciprocity because even if, when you look at the US texts, there is a reciprocity, it's not a total reciprocity, it's just for a part of FATCA. And so when you speak about the balance, there is the need to have that in mind. And so the only way to make sure that everything will be okay is to put everybody around the table and to make sure that there will be a total transparency and a total reciprocity. That's all I wanted to say in this context.
Did anybody else want to answer on that one? Katja, go for it.
I guess one thing that I'm worried about is that we kind of think that just by reporting a lot of information to the tax administrations, we can then check the box, oh yay, we are tax transparent. But it doesn't work like that. I think what we should keep in mind that in order to the compliance costs to be justified, the data must be in a format and in a form that the tax administrations can actually utilize. And the tax administrations must have sufficient IT systems in order to process that amount of data. So just by imagining that we just push the data to tax administrations and be done with it, it won't enhance tax transparency. So that's why I would add this aspect to the discussion, that if we really want to think about whether the costs are justified, we should also consider whether the actual data can be utilized by the tax administration and whether it actually enhances tax transparency in practice. Thanks.
Thank you, Katja. We had a couple of additional questions come in on the Q&A, but I wanted to try and get through them before we finish. The first one was, what if we end up with an EU trace-like system, what would that mean for the Finnish trace?
Well, I guess that's for me. That is the question that we are also wondering about. I guess we'll see. We, of course, are hoping that it will be an EU trace, which would mean basically nothing for us because we are already adapting trace. But that is up to the Commission, what kind of initiative they are gonna provide. But we, as the tax administration, are of course hoping for an EU trace and not EU trace-like system. But we'll see. No one knows at the moment.
And then the second question was, might we see greater tax transparency in the US under Biden? Perhaps implementation of DF 1504 or the current Corporate Transparency Act going through Congress? Anybody have a view? Alex, go for
it. Well, I mean, just because it feels in the political space, it's slightly difficult. Everyone is trying to read the tea leaves of Biden at the moment. On the one hand, his sort of roots are as the representative of Delaware, right? So, the longest standing tax haven state among what are now many. On the other hand, well, two things. One, Delaware itself has actually had a slightly aborted process, but nonetheless tried to bring in some beneficial ownership transparency. So even there, things are moved a bit politically. But then Biden has made very public statements about committing to the global fight against illicit financial flows and recognizing the issues around beneficial ownership transparency, even obliquely, I think, to the problems with non-reciprocity under FATCA. So you can imagine potentially Biden reversing Obama's U-turn, where Obama pulled out, having initially agreed to be part of the OECD Common Reporting Standard. And then, as Tim Law in the question references, you have going through Congress potential measures that would introduce beneficial ownership transparency, would also require public country-by-country reporting for US multinationals. And of course, if the US does that, if the EU hasn't already moved, then I think we'll see the EU follow, and that gives you something very close to global coverage for that, at which point the OECD can say, it's only really Japan who's still holding out against this. We can make this a standard. So you can see how it could tip over. On the other hand, Trump being the president has kind of energized the case for financial transparency around the world, because you can see the extent of secrecy and corruption that's run through that administration very clearly, and that's kind of got people who might not otherwise have seen this as a priority to engage. So there might be a downside to having a US president who's kind of on the right side, but perhaps not willing to prioritize it, if that's where we land. So I guess we watch this space and keep pushing.
Well, on that very interesting future-looking perspective, I'm going to say thank you very much to all four of you, to Philippe, Katja, Alex and António, for your interesting perspectives. We've had quite a range of conversations and some interesting questions from the audience, so thank you for that too. So I think we should sign off to let people go to the loo before the next session starts. Thank you very much.
Thank you.
Thank you. Have a nice day.
Cheers.
Thank you.